One of the biggest problems with investing, be it with $100, with $1,000, with $10 or even $10,000, is deciding whether you should be investing it in a lump sum or to be investing over a period of time. So in this video, we're going to dive right in to find out whether investing in a lump sum or investing via dollar cost averaging actually brings you a better return. What's up guys, so my name is Jordan and welcome to my channel where we talk about personal finance and everything that's in between. Bailey's tail is in camera. Alright, so if you're in a situation where you're thinking, I have $1,000 now or $10,000 now, should I be investing a lump sum into the market or should I be buying stocks and shares over a period of time? So this is a question that a lot of people are stuck with and they're not sure whether they should be approaching it with a lump sum approach or by investing over a period of time via dollar cost averaging. So that is what we're going to explore in this video, and I've drawn out some examples. It took me a lot of time to come up with a table to show you the comparison between doing a lump sum investment and doing a dollar cost averaging investment. Okay, so before we get into the numbers of it, something we have to understand is what does lump sum investment mean and what does dollar cost averaging mean. So with lump sum investment, it means entering the market with $10,000 and exhausting that $10,000 into a certain share or into a certain ETF or into a certain index. And then we have dollar cost averaging, which is a constant effort of putting money into the market to buy a stock or share regardless of price, to just get exposure into the market itself. So for this example, we'll be using Straits Times ETF or the STI ETF in that sense. Ticker is ES3. Which tracks the Singapore Straits Times Index in the Singapore exchange market. Over here, you're able to see my Tiger Brokers portfolio. These are shares that I've been buying across a period of time. Thus, I'm using the dollar cost averaging method. I think within the last 2 months, I started in April, and this is something that I've accumulated so far. So let's compare the differences between a lump sum investing and using the dollar cost averaging method. Hey Bailey. Okay, so we're going to have a few assumptions here. Just for the sake of example, we're going to use an initial capital of $10,000 for both examples. We're going to be investing into the same stock, which is the STI ETF, ticker ES3. And then we're going to be looking at investing over a period of 1 year. So, I could do a 10-year example, 5-year example, but just for example's sake, I'm just going to use 1 year. And we're going to take 2019, for example. So we're going to start on the 1st of January 2019 all the way to 2nd December in 2019. So that will be a good 12-month period to track how well does lump sum investing work or how well does dollar cost averaging work. Alright, so we're going to track the price on the 1st of every month at close. That will be the price that we are going to buy the stock at on the 1st of January in 2019. The stock price is $3.11. Trading fee is roughly $25.55. This gives us a total cost of $9,977.55. So we didn't exhaust the full $10,000. We do have a little bit of change, which is $22.45. And this gives us about 3,200 stocks of STI ETF and an average stock price of $3.11. So if you fast forward to 12 months, which is in December, the closing price of STI ETF on the 2nd of December was $3.24. So we made a good amount of profit here. Trading fee is about $26.63. The total cost to us is $10,341.37. So essentially we made a good profit of about $336 after fees and everything. So this is what you get with lump sum investing. You do get to see gains like this. And now let's take a look at dollar cost averaging. So we're going to take the same assumptions again. The only difference that we're going to make here is that instead of a $10,000 initial capital, we're going to split it up into $1,000 every single month. And this will last us till October because there's 10 months from January to October, and that is $10,000 right down there. Okay, so let's just take a look at the charts and a little table that I've created. So on the 1st of January, we'll buy the stock, same as lump sum at $3.11, paying a fee of $11.10. Total cost will be $941. So you're gonna see this is a lot of information. I'm just gonna put it up on the screen here so that you guys can take a look. All right, so if we fast forward to 12 months in December, and we sell, and let's say if we do sell all the stocks to realize a profit or a loss, we do realize that we have a loss of $300 with dollar cost averaging. And I think most of you are gonna be saying,
"Oh, Jordan, how can we be losing money with dollar cost averaging? Because everyone says dollar cost averaging is the best strategy in the stock market."
that is true. You shouldn't be losing money with dollar cost averaging if the market is going downward trend. So if the market is in an upward trend, it's an improving market, dollar cost averaging might not be the best strategy out there to accumulate shares in that sense, because the amount of capital you put in every single month might not be able to buy the same amount of shares as you used to, because the prices of shares are going up every single month. In our example, in January 2019, the STI ETF was $3.10 or $3.11, but then in July it went up to $3.40. So the amount of money you put in to buy the amount of shares in January versus July is going to be very different, because there's a 10% increase in the share price, which means you are buying 10% lesser shares in July as compared to January. But however, if you are using dollar cost averaging as a method to accumulate shares, this will work best in a downward trend market, because if the prices of the shares keeps dropping, the amount of money you actually put into the market is going to allow you to buy even more shares as the price continues to drop. But this is not to say that dollar cost averaging is a bad strategy. This is just not a strategy to use if you are trading in a growing market or a market that is going upward trend. So for example, if you're trading in a market that is going upward, a lump sum investment might be the best strategy that you might want to employ, because you are buying stocks at a cheap and selling it at a high. But here's the thing, we never know when is the lowest point of the low, and we never know when is the highest point of the high. Okay, so where does dollar cost averaging actually work best is when you're trading in a downward market. So for example, if you're trading the pre-virus stage, share prices were dropping, and if you're entering every single week or every single month, you will have probably dollar cost average your price of share down to as low as the lowest low, because we never know when the lowest low is, and we never know when the highest high is. Dollar cost averaging helps you to reduce the price of your shares and allows you to make a bigger profit if the market goes up. So I'm not a certified financial advisor. Do not take what I'm going to say in the next 2 minutes as financial advice. But if you are in your 30s, you'll be working for a while, you have a lump sum of money to spare that you want to invest or have been thinking of investing, a lump sum investment is something that you can look at, because it's going to give you more gains if the market is going up. Like in current times, the S&P 500 is still going up, the STI ETF is also going up, the Straits Times Index is also going up. But conversely, on the other hand, if you are maybe you just finished college, you just finished school, or you're just out of NS, you do have a small sum of money, you can consider using the dollar cost averaging method to get some exposure into the market. But with dollar cost averaging, something you have to take note is to be very disciplined and to be very diligent in putting aside money every single month and to purchase the shares regardless of price. So this way you're able to accumulate shares, and by the time you reach your 30s, you will have a good number of shares that can probably bring you some good gains, because as history has shown, the stock market will always goes up, and it has been going up since the Great Depression, since the 2008 financial crisis, and even the current one is still going up, and it has even surpassed its highest high. So in summary, if you're going to go into a lump sum investment, do take note that lump sum works best when there is an upward market or the market is going in an upward trend. And if you are going for the dollar cost averaging, this works best if the market is going in a downward trend or if you're just starting out. But at the end of the day, it really depends on what kind of investor you are. If you are an experienced investor, lump sum might be something you are looking at, because you are probably able to get better gains as compared to using a dollar cost averaging method, because you do have the experience and you do have the exposure. But if you're inexperienced, you are new, and you want to get a little bit of exposure and try to get a little bit of skin in the game, you can try out dollar cost averaging. But do not take this as financial advice. All of these are for entertainment purposes. And if you have learned something from this video, do drop a like, make the button turn blue, subscribe, and let me know in the comments below, do you prefer trading with a lump sum investment, or do you prefer trading with the dollar cost averaging method? And I'll see you in the next video.